I think the central problem, Melissa, is that we have a 3.7% unemployment rate, and even modest growth, even 2% real GDP growth, is going to be enough to continue to aggravate cost pressures and price inflation and keep rates probably trending higher. And we'd probably be okay with that if we were trading at like 15 times earnings, but not where we're trading yet today. So I just think ultimately when you put enough pressure on the system with the rate structure and inflation structure, that eventually it breaks a little bit. And once it breaks, then you get people that find out they didn't get what they bargained for, and you get a lot of selling. Probably until this thing has to burn out now, and I'm looking near term here just for some show of real panic, a real move in gold, a real move in the bond market, bond yields coming down, a move up in the dollar, things of that nature. And I've been kind of surprised that we haven't seen that already, but if this keeps up, we will probably pretty soon.
I'm going to ask you, what's the nursery, Little Miss Moffat, Senator Tuffet, Eating Her Kurds Away?
That's the one.
Is the Fed rate path too hard, meaning hawkish, too soft, meaning slow, or just right?
Well, I don't think they have much choice, Melissa. I mean, I think they've had to raise rates here. We've got really strong real growth of late, and then you just had the core CPI 2 months ago set the highest year-on-year growth rate of the recovery. PCE's at an 8-year, 7-year high core. Inflation wages just set a new high year-on-year a couple months ago. Inflation expectations are close to 4-year high in tip bonds. Commodity prices are 4-year high. Crude, WTI just broke through $75. I don't think they had much choice but to continue to raise rates. Did they cause this? I think so. And I think the real thing, the next shoe to drop, is that we're going to find out that higher rates, monetary tightening, energy cost is going to lead to an economic slowdown, probably much more severe than what Wall Street was anticipating.
So you agree with the Fed?
I
mean, you agree with the president? You think the Fed caused this? I just hear you say that.
Well, I think they had no choice. I don't think they're not doing what they need to. I think they're doing the right thing. We need to moderate this recovery right now, Scott, if it's going to continue. If we can moderate it,
Dow's
slow
down
it
500,
down.
by the way, as we're having this conversation.
I want to also point this out, guys. One of the drivers here, we are seeing, you mentioned, Jim, this idea of an absence of a flight to safety. We are actually seeing a bit of that flight to safety now. We are seeing gold prices on the rise. We are seeing yen gain some strength. We have now seen the lows of the session in the 10-year U.S. Treasury note yield now below 3.14%. It was pushing 3.25% just a handful of days ago. So all of this, as it plays out, does it tell you now that there is perhaps a risk-off sentiment building in the market?
Yeah. I think that's right. Defensive stocks have been outperforming. You've had pretty dramatic performance. I mean, part of today they weren't, but you're going to see that again now with utility stocks taking off probably. Gold is certainly looking better. The one that's really the stickler is the bond yield, sticking around that 3.15. It's off from maybe 10 basis points at most. I wouldn't be surprised if when this thing gets done, we'll break 3% again on the 10-year in a panic rush to bonds. Overall, I just think it seems too controlled. In some regard, the January sell-off was similar until right at the very end for a very brief period. And there's too many, I think, there's too much sentiment yet, Scott, that this is just a refreshing pause, a buying up, a normal bull market correction. I think it may be that, but I don't think it can end when most people think it is. I think when it does finally bottom out, there'll be a lot of calls for bear markets, maybe calls for recession and that type of thing. And we're maybe starting to get some seeds of that today, but I'm not sure we're there yet.
Right now, financials and healthcare are down each by more than 2.5%. We want to bring in Kenny Polcari, who joins us on the floor of the New York Stock Exchange. Seems like it happened, turn of the dime practically at 2 o'clock. Kenny, what happened?
Right. Well, you know what? And we've been talking about this, right? And I said it yesterday. I said it again today in my note. It is all technical now. As far as I'm concerned, the market's not paying attention to fundamentals, doesn't want to hear about it anymore. We've suffered technical damage both on the NASDAQ and now at the S&P. We tried it twice today to hold at the 200-day moving average on the S&P. The first time we rallied back. The second time we tried it and failed. And so therefore it sets it right up to want to test lower. It's almost a flush. You can feel that it's a flush right now. And the market and the algos are not paying any
What's the
attention.
test to the downside at this point in your view, Kenny?
I think it's 2,700, which is kind of this round number. And if we go, and if it doesn't hold 2,700, it's going to go back to, I think it's the, I don't have the chart right in front of me now. Then it would be closer to 26, 25. After that, you'll see, I forget when it was, maybe March or maybe this time last year. I have to look at the chart, but 27 for sure. And I think we're going to get there relatively quickly. It feels like it certainly, if the tone stays today, we're going to be there in another 10 minutes. But if we don't hold 2,700, then you go into the 26, 25-ish, 2650 level.